What is up, traders? Hope everybody's doing well. Today's lecture is going to be talking about macros, what they are, how to spot them, how do we use them, and all that. So, what is a macro? A macro is basically a specific time of day where the market speeds up or speeds up the pace or carries its momentum, starts to move. Just in general, it's a time where the market moves a little bit quicker relative to the other times of the day, right? So a macro is basically the ending in the first 10 minutes of each hour. Each hour of a day, the ending 10 minutes, so the last 10 minutes in the first 10 minutes of each hour. So from 3:50 a.m. to 4:10 a.m., the 6:50 a.m. to 7:10 a.m. Every ending and beginning, last 10 minutes and first 10 minutes of each hour is considered a macro, but not every macro has the same effect as the other. There is specific macros that perform better, that have more speed, that have more liquidity, and those are the ones that we're going to be focusing on, right? The macros that we're going to be focusing on mainly in this mentorship or in these lecture series are three macros: the 950 to 1010 macro, 1050 to 1110 macro, 150 to 210 macro. These two macros are in the AM session. This macro is in the PM session, obviously, right? Because market opens at 9:30. So the first two macros are considered in the AM session, and then the last one is considered in the PM session. Okay. Now, before we start, out of these three, the two that we use the most are the first two, the 950 1010 and 1050 1110. Because the reason being is usually we do not want to be trading the PM session, simply because out of these three, the movement is the least in the PM session out of these three. That's number one. Number two is there are specific days and specific times that we want to be trading the PM session, and other days we don't want to be touching it even, right? I'm going to be going over these days later, but for now, there's days where we don't even want to touch the PM session. There's days where the only session that we want to trade is the PM session, because the AM session, for example, will have very, very volatile news and whatever. So these are the three main macros that we're going to be talking about. Another very important point to harp on is this does not mean that, for example, 950 1010 macro, this does not mean that before 950 there's no movement. No. Especially this macro, because the market opens at 9:30. This whole time is volatile, but the specific time between 9:50 and 10:10 is a time where we want to look for entries and trades to specifically take us to a certain liquidity that we're targeting. Because this is a new information. The first 30 minutes of a market open, so from 9:30 to 10, there's a lot of manipulation, especially the first 10-15 minutes. So the 950 1010 macro will kind of, in a way, just filter out all that manipulation, reduce the amount of stop loss we're going to hit, stop losses that are going to hit, take traders out, and then give us a clean setup to take us to a specific pool of liquidity that we want to target, right? Same thing for 1050 to 1110. It does not mean that before and after there's not going to be movement. No, but generally, the amount of movement in the 1050 1110 macro is a bit more than it's like the times before and after, if you get what I'm trying to say. It's just a period of time where the price speeds up a little bit. Now, this doesn't happen every single day, but usually this is the case, right? These macros speed up price. Where? To target liquidity. That is either, we talked about equal tops, equal bottoms, daily highs, daily lows, weekly highs, weekly lows, to reprice to inefficiencies, volume imbalances, liquidity voids, all that kind of stuff. Okay, so we're going to go through charts now. I'm going to show you guys real life examples of how they look, and yeah, let's get to it. So the first kind of macros that I have marked out here. Now you're going to notice that I have it marked out in 15-minute intervals, so I don't have it marked out as, so if you look down here, I don't have it marked out as 950, 1010. The reason being is you can look for trades 5 minutes before and 5 minutes after these macros, right? That's why from the beginning, I want to ingrain in you guys that the macro is quote unquote 9:45, 10:15, or 10:45, 11:15, or 1:45, 2:15. The actual macro is 10 minutes, but we can look to enter the market 5 minutes before if the entry is presented. Hope that kind of makes sense, right? So if the entry is presented as early as 5 minutes before the macro and 5 minutes after the macro, we can enter, right? But if, for example, the movement happens, okay, so hope that makes things clear. Now, let's take a look. This is the first macro here. So let's take a look. This is the first macro here from 9:45, which is quote unquote 9:50, right, to 10:15. Okay. You can see here, even if you look at the broader view, how during this time, price kind of starts to spool, move quicker in the direction that we need. We can clearly tell now in hindsight that the draw on liquidity was lower because price drew lower, right? There was equal lows here, here. We can see all of these sell side liquidity pools here that price wanted to target. But before, in that first 30-minute interval from here, let's say 9:30, we can see how there was this false move taking out traders. But then during that macro, it kind of gave us the clear direction it wants to go to, right? And it started to initiate speed to liquidity, right? So it swept the first form of sell-side liquidity here, but there's still more liquidity. So if we zoom out, we can see here that there's liquidity that wasn't taken yet by the market. So if we go to these lows right here, this right here was not taken yet, right? So at this time, by this macro, what was the low? This was the low, for example. By the way, this is between 10:15 and 10:45. So this is not a macro, right? And you can see how price kind of slows down, right? You can notice that. So between the first macro, look at how price moves, this macro, look. And when the macro ends, look at how it kind of slows down. And then it picks back up again during the second macro of 10:45, 11:15. So you can see that. So what happens is the first macro starts to spool in the direction that the market wants to go to take out. In this case, it was sell-side liquidity. Then it kind of consolidates. And then during the second macro, which is 10:45, 11:15, it starts to spool again to more liquidity. What did it target here? Well, we can see here that we had more sell side that wasn't swept yet. We had this low that was swept. So if we take a line and we drag it across, you can see how it was swept here very handsomely, right? During what macro? The second AM macro. Sound nice? Now, as I said, again, this doesn't mean that outside these macros, price doesn't move, but generally, these macros have the most volatile movements and they take us to where we want to go, the liquidity, where it's resting. The macro ends here. We have a grind up, move down. We have a sharp move down, see? By the way, when did this happen? If you look down, 1150. Look at this, 1150, 1210 macro. You can see how price starts to spool. Because I said earlier, every hour is a macro where price does speed up. But the ones we're going to focus on, and it's for a reason, because they're, let's say, the most clear and the easiest to trade. Let's put it that way, right? So during the 1210 macro, price did spool, right? And then we come down here, even this macro, 1250, 110. We can see how price started to spool. Kind of consolidates in this region. And then during the macro, it speeds up, consolidates in this region. During the macro, it starts to speed up. And then during the last macro that we're going to focus on during the day, it does its last push. You can see here how during the quote unquote the 150, quote unquote 150, 210 macro, but we're going to do 145. I explained why. Price starts to spool. You can see here how it does its final push like down, and then after that, after the macro is done, it just consolidates. Right? Let's take another beautiful example over here. Let's see. This is another example. We can see here how the first AM macro, look at how price really actually consolidated. And the move happened before. We have a very sharp move up. But when was this? 9:30. So I told you guys during the 9:30 open, there's a lot of volatile movements. But the 9:50, 10:10 macro kind of gives us the cleaner move that price wants to do. And it actually did draw to them some liquidity, right? We had this low right here where there's liquidity. We discussed that liquidity does rest below previous highs and lows. So this was a pool of liquidity that price did reach to. Right? It didn't reach this pool, which it later did. Okay. So, which by the way, did start in the 1045 or 1050, 1110 macro. So let's stick to this macro for now. We can see how during this macro, we really didn't have any speed on price. If anything, it slowed down, right? So that's why when I said that usually the case is during these macros, price speeds up. But during this specific day, it just kind of did nothing. I mean, you know, at the end of the macro, it did kind of spool down and then it pushed up. But then during the 1045, 1150 macro, we can see how price start to spool, but where? In the intended correct direction, right? So this, looking in hindsight, like this movement was the wrong movement, which happened outside of macro. This area is not a macro, right? This is between 10:15 and 11:45 and 10:45. This is not macro. You have a nice sharp up move up, but this was the quote unquote the wrong move, the wrong direction. During the macro, price did spool into the quote unquote correct direction, right? And it took us below these equal lows. Now here, sell side liquidity swept it, but the point is it was initiated during what macro? The 1045, 1115 macro, or 1050, 1110 macro, right? I'm gonna from now on, I'm gonna keep on saying the 15-minute interval one. So 1045, 1115, but you guys understand that the macro is 10 minutes before and 10 minutes after, right? But I explained why I'm gonna do it 15 minutes instead of 10 for the entries, right? I want to ingrain it in you guys for the entries because we can enter 5 minutes before the macro, 5 minutes after. You could look for entries, like in this case, for example, quick. Right here, we have a very nice breakout structure on the 1 minute chart. We have a high, a low, a higher high, and then we broke structure right here, right? So this is a breakout structure with a fair value gap. Where is that fair value gap? It's right here. So if we zoom in very nicely, we have a fair value gap right here. You guys can see it on the 1 minute. So this is a fair value gap, like so. Breakup structure on the 1 minute right here. We closed below the candle. For breakup structure, it's a close below the candle. But for order blocks, it's a close below the wick. So if we're looking for order blocks, where's the order block here? So the order block here, since we're now in a bearish trend, the order block is the highest up close candle, which is these consecutive ones, right? We have this. So it's all of these three. And we can see how price later in the future. So from here to here, see how price later in the future did come back and retest them right there. beautifully, very beautifully, right? So again, if we were to enter, right, we have a breakup structure. This region became an order block when after the lowest wick was closed through. So on this candle, this became an order block, right? But for me, as I said, I told you guys that I don't really use order blocks too much. I like to enter off of fair value gaps. So my entry, which I do remember I took this trade. So we broke structure right here on this candle, right? Where do I have value gap? It's right there, handsomely, waiting, sitting. You would have put your short position. You would have very beautifully put your short position on that fair value gap. Stop loss above structure, which you could have put it here or here, but I would have put it above here. And then you would have put take profit beautifully at these equal lows right here. TP would have been smashed. I believe I do remember I took this trade. So that's how you would kind of go on by looking for a trade. You would wait for the macro where it would spool to a specific direction, equal lows, equal highs, fair value gaps, and that good stuff for liquidity rests. And yeah, just like that. That's our basically, like right now I just went over our bread and butter setup. Now there's also other things like the new day opening gap. Like, by the way, we can see here how beautifully on the December 1st new week opening gap. This was the previous lecture, I believe. Look at how price respected that very handsomely, right? So there's other factors to include when we take a trade that will help us, will guide us. We're going through them, right? But that's basically how we would look to execute our trades. Now, let's look here on the PM session. We can see here how price, after doing that initial move, it kind of just consolidated. Just not really, yes, we had a movement here. And by the way, what was the macro? We look 12:45, right? This is where kind of start to pick up and push, but it kind of really just consolidated. And then during this macro, which is the PM session macro, price sped up where to take out this low, tap into this inefficiency, this fair value gap, right? And then it reversed with speed actually as well. So it initiated this movement and this movement, right? But we can see that the magnitude of the movement is nothing like the AM session macros, right? Like look at this and look at this, right? That's why in most days we try to avoid the PM session macro and just stick to the AM session. There is specific days where we want to trade the PM session, but we'll talk about that's the advanced things. We'll talk about that later. Of days where we want to specifically trade the PM session, right? But for now, yeah, we can see how the macros play out. Let's go over one last example. Right here, let's go. Let's try this. Let's do this. So right here, we can see how during the first AM macro, how price sped up. Look at price action here and then the difference during the macro. Like you can tell how price speeds up and starts to spool in a certain direction to take out certain liquidity. And in this case, it actually spooled up, took out this liquidity, and then spooled down to take out all this liquidity, right? We have double tops. We have the December new week opening gap, January new week opening gap. So yeah, it pushed up and then proceeded to push down, take out these lows, all this cluster of lows. We have all this new week opening gaps, which is a magnet. We discussed that. They act as magnets. And then we can see here how during the second AM macro, during the 10:45, 11:15 macro, how price kind of consolidated around this region. And then we can clearly see the difference in how price moved between, like, look at this. This is the macro, before the macro. I'm going to color before the macro in, well, let's color this in red. can clearly see how outside the macros, like this was a beautiful day to kind of, outside the macro, price was aimlessly moving, consolidating. You know, if you were to trade in before the macros, it would have been chopped up. But then we can see how clearly during the macro, price just speeds up and goes to where it wants to go, like that, right? So nice example. Then we go to the PM session. PM session again, we can see how price was just kind of consolidating before it. During the PM session, even here, nothing happened really, which is the PM session macro. Again, that's another reason I told you guys the PM session usually, but even they're like, look, you do have an initiation to go. Like right here, we can tell that you have equal highs right here, right? You can very nicely to see that you have equal highs right here, right? You have this high and this high. You have this high and this high, right? So it's clear, kind of, right? So in hindsight, it's clear that price wants to target that. So during the PM session, you have this spike. It does initially like push price, right? You have price kind of grinding higher. It does have a nice push here. Then during the macro, it does in the beginning of it consolidate and then starts to push price higher. But again, like the PM session is the least volatile of all those sessions. There is specific days, like I'll give you an example here, a very beautiful example. It was actually on Friday. Look at how the PM session just exploded. So this is, look again, this was the pre-market. This is the session. This is between the macros. This is the macro, and now then you have this. So in red is the macro. Look at this. The difference in how price moved, right? And then very clear. But then look at this. The PM session in general on Friday was just hectic. You can see how price just starts to spool lower. During the PM session, it consolidated at the beginning of it, or the PM macro, sorry, then starts to continue to spool, consolidate after the end of it, continue to spool after. So in this case, the PM session was very volatile, right? Again, that goes back to knowing when to trade these days. Generally, when you have a market that is on Friday, you don't want to trade the PM session unless, like this day, you had unfinished business, which was, there was a new day opening gap. I don't have it marked out, but this was right here. This was a new day opening gap right here. This new day opening gap was unfinished business, and it was Friday approaching the market to close. So when you have things like this where there's unfinished business, it's a Friday, and we're in the PM session, this is where you'll see market speed up like crazy. Look at this drop, right? So days where you would want to trade the PM session is when you have unfinished business on a day like Friday, where it's the end of the week, and we're approaching the PM session, there's still like there's work that hasn't been done. Price will go to where it wants to go quick in the PM session, right? So unfinished business, unfilled gap, daily gap, price did its work all up in here, but it wasn't done here. So what they do, the PM session absolutely crazy, dropped and moved very, very strongly to its target. So but usually Friday's PM session, like by the time we're at Friday, the PM session market has done its work. This specific day had done its work, so I want to do it quickly. Usually like when the PM session approaches on Friday, all the liquidity of the weekly objective has been reached, all the good stuff. So the PM session on Friday you would want to trade. There's certain conditions where you want to trade the PM session, certain conditions where you would. If you have very volatile news in the morning session, you would generally want to trade the PM session. If you have a lot of volatile news in the PM session, you would really not want to trade the AM session. So I'm going to go over those actually in another lecture where I talk about news specifically. So don't worry about that. But that's going to be it for this lecture. Watch it again if you need. There's a lot of information in this lecture. But yeah, if there's any questions, shoot them. Until next time, guys, I hope you found this insightful. Until next time, stay safe and happy trading.